Hello and welcome to another episode of Real Deal Investing. I'm one of your co-hosts, Jerron Kelley, and my fellow co-host, Larry Mastropieri. I am a real estate investor, multifamily investor, as well as a real estate attorney. Larry is a real estate broker and also a multifamily investor. Today, we're excited to have Nizan Mosery today. Nizan's a great guy. Larry and I have gotten to know him pretty well here in the last year or so. Nizan is a very accomplished multifamily syndicator. He's put together a large number of successful deals throughout the U.S., mostly the Southeast, but we'll get into kind of geographic locations and your deals here. But let's just start with a warm welcome to you, Nizan. Thanks for joining us today.
Thank you for having me. Appreciate it. Welcome, everybody. How you doing?
Thank you. Good stuff. So what we always like to do is just to get started is to give the audience a little bit of a background about who you are, where you grew up, where you're from, and sort of your journey into real estate and how you got into it.
Yeah, sure. Well, originally from New York City, born and raised in Brooklyn, New York. Go Brooklyn. First generation American. My parents came over from Israel, and then I was born first generation American. I kind of joke, but it's true. My father always told us when we were kids that there's two types of people in this world, those that pay rent and those that collect. And son, you always want to collect. So after high school, growing up in New York and that mentality and whatnot, after high school, I went back to Israel, did a little stint in the military over there, and then came back. And I didn't have a place to live. And I obviously went back to live with my parents. And one night, my father was giving me a hard time about getting dressed and going out at 11 o'clock at night. And I was like, okay, I got to go find myself a place. And I started renting an apartment. And man, was he pissed. He just couldn't understand. He goes, didn't I teach you anything? What are you renting? It's like you're burning money. You're throwing out money. You're not building equity for yourself. So that was really embedded in my head. And then, years later, and I went on to study at Pace University. I never graduated, so I'm not a college graduate. Went traveling for many, many years. My father passed away when I was 25, so that kind of threw me for a downward slope. But when I was in New York, I was working with my brothers. We renovated the properties that we had. We bought some old commercial pre-Civil War buildings, the 1800s and whatnot. So there's a lot of renovations that had to happen there, fixing the elevators, the water tanks, renovating the 10,000 square foot floors. So I grew up doing all of those renovations and, the black sheep of the family, right? Giving them all the nice jobs, right? Go clean the toilets, go fix the water tanks and whatnot. And I grew up in that slowly. And so when my father passed away, I went to travel the world, didn't know what I wanted to do, ended up in Israel. And then in 2000, and bought real estate in Israel, bought real estate in South America, had a renovation and restoration company in New York with my brothers. So I was always involved in real estate somehow. In 2009, my wife and I decided to move to the States just because, we were two big hippies. At the time, I had 4 feet of dreadlocks and I had a big goatee. So I was a big hippie, traveling the world, not knowing what I wanted to do in life. But then, what happens? How do people get serious in life, right? They suddenly have a kid. And like, holy cow, really? I can't. I gotta straighten my act up. So we decided to come to the States for about a year and see what was going on. We bought the house here in Boca. We were going to live in it for a year and then sell it, make some money, and move on our way. And who knows, Thailand, New Zealand, somewhere. And next thing you know, it's 14 years later. I've flipped hundreds and hundreds of homes, renovated, did all that. Slowly got into the multifamily world because I realized I was very lazy. I didn't like to work. I don't like to get up in the morning and go sit at a desk and work. That just wasn't me. So I had to figure out how could I create something that would give me the freedom that I wanted. So I started looking and searching for people that could teach me about multifamily, about rentals, about exactly how to underwrite and the pitfalls and all of that. And I found a mentor and I bought his home study course. And of course, I did everything that he said not to do, I did. Right? He broke it down to different neighborhoods. There's A neighborhood, B neighborhood, C neighborhood, and then there's D neighborhoods. And the D neighborhoods stand for drugs and drug dealers. And that's where you don't want to be. And of course, in West Palm Beach, I found myself a nice 4-unit foreclosure on the wrong side of the tracks. And I said, sure, why not? Let's buy it. So I bought it. It had a drug dealer in one. It had a a lady of the night in the other. It had her boss in another unit, and then a single mom with her daughter in another unit. When they all paid rent, it cash flowed beautifully. But, you know, to go get them to pay rent was a task in itself. So I bought that, and thank God I was able to sell it and make money on it. Then I bought a duplex in the south side of Chicago, again in the wrong part of Chicago, and that was another fiasco. So I learned through the school of hard knocks what to do, what not to do, all of the challenges and whatnot. But what I found was that I was doing all these deals with my own money. I would buy a house, I'd fix it up and flip it and sell it. I'd get my money, and then, okay, I would buy the fourplex. Then I'd have no more money. I had to wait, you know, gather up some more funds and then go buy another property. And then one day I was sitting in a room, and the guy in front of the room was saying, you know, you can use other people's money to fund all your real estate deals. And I was like, say what? Really? Because, you know, growing up in New York, even here, right? You walk down the streets and you're looking at all these big ass buildings and you're going, who has that kind of money that can go and buy 150, 200 story floor or whatever it is in Manhattan, hundreds of millions of dollars? How many people have that kind of money? I didn't realize that all these buildings were syndicated, that they actually went out and raised money from people and then they bought the property with other people's money.
And with financing.
And with financing, of course. So you have the debt,
sure,
and then you have other people's money.
For the equity, yeah.
And then and you're sitting there and you're making money. So this was a game changer for me because, as I said earlier, I'm not a college graduate. I didn't have anything to fall back on. This is all I knew, but I had limited funds. Mm-hmm. So my future wasn't as beautiful as I wanted it to be. But when I heard about OPM, other people's money, that just lit up my world, and I saw a new future for myself and my family. I said, well, all I need to do now is talk to a ton of people and get them to invest with me. And little by little, that's what happened. And today, you know, we're closing on a $22 million one-year-old student housing project in Athens, Georgia, this week, either this week or next week. Closing is happening. So it's been an incredible journey, and learning to use other people's money has really exploded my business and enhanced my future.
What was the first syndicated deal you did? Like, what was the size? What did that look like?
So
was it messy?
It was. So the first syndicated deal that we did, we partnered up, my partner and I, we partnered up with another syndicator. He was a sponsor. He had a Class A property. It was a brand new property. I think it was like a 4-year-old property outside of Dallas in a city called New Braunfels. And he had it under contract, and he was raising capital for it. And we partnered with him on that project. Now, he was raising $4 million. My partner and I, we put $25K each together, and we invested as a limited partner, as a regular investor. And then we went out and we raised, I think, $100,000 or $150,000 from 2 other people, and we invested that capital. And that was the first syndication that we ever did. So we were a minority partner with no say. Well, I mean, the say was that we had to take care of our investors. We had to put together marketing. We had to do market research and comparables and whatnot. But that was the deal. And we had a very, very small piece of the pie. I mean, it was less than 1%.
Because you did that, because you helped raise money, did you get a piece of the GP?
We did.
Okay.
We did. We got a piece of the GP.
And just for those people who don't know, we're talking in real estate lexicon.
Right.
LP is limited partners. That's typically for those people that put in money alone and do nothing else towards the kind of what we'll call like the sweat equity of the deal, right, of all the work. Those people that either find the deal, and we'll get a little more into this, to find the deal, the acquisition side of it, or the underwriting of it, or the management of it, disposition of it, they then get pieces of the GP, which is the general partner equity that's in that. And so that GP is normally the sweat equity. So the people who are doing the work get, let's say, hypothetically, 30% of the upside of the deal over a certain percentage, guaranteed percentage. And the other 70%, let's say, and those percentages can change. The other 70%, let's say, is left for the equity for the LP, the excess equity. So hopefully, I don't know if I explained that.
So there's financial benefit to being a GP, but there's work involved in it.
Right? There is work involved.
Yeah.
You can't just sit there, twiddle your thumbs, and what. Everybody who's a general partner has to play an active role on the day-to-day management of the asset. Now, it's not property management, right? Because we put a property manager in between us and the tenants, but we then go back and then you have the property, then you have the property manager, then you have the asset manager, and then you have us managing the asset manager. The general partnership manages the asset in a whole, making sure, I look at it like a ship, right? So the GPs, we're the skippers of the ship, right? You have the skipper, you have the XO, you have all the executive officers, and that's the GP. We make sure that the ship is sailing in the right direction, all the parts are moving, the engine is running smoothly, everything is running, all systems are go, and it's moving in the right direction. The limited partners, LPs, they're limited because they have a limited liability, right? That's a key. When someone invests, like, well, what happens if it goes sideways? What liability do I have? As an investor, you have a very limited liability, right? You probably won't even get touched by creditors or anyone. That goes to the GP.
It's really limited to the investment they put in. If they put $100,000 in, the risk
that's their liability.
Is their liability. If the world ended tomorrow and the property prices went down by 80%, which they're not happening, then they would lose their $100,000. That's the extent of it. They're not going to come after them.
They're not going to come after them. There's no recourse on them. No recourse. There's nothing, right? So that property, then what it did is it put us on the map. It put us on the map as syndicators, as part of a GP team. Because, as brokers and whatnot, right? What's the first question, you ask a buyer? What was the last deal you've done?
Yep.
Who's on your team? What have you accomplished? And as a newbie, you're sitting there going, the last deal I've done.
I did a fourplex.
Some people haven't even done that, right?
No, I know, right? Hey, maybe nothing.
I was talking to a woman who, she's sending me hotels. She wants to underwrite hotels and these big, Marriotts and whatnot. I go, well, do you have a team? Do you have a general manager that can look at? She goes, oh, I have nobody. I go, so how do you plan on getting a Marriott that's $150 million? Who's on your team to help you even get through the door? So it helped us build credibility for ourselves. And then from there, someone it's all about networking as well, right? So we're involved in all these networking groups and conferences and whatnot. So at one of these conferences, after we closed on that asset, somebody came to us who lives in Hawaii. He was building this relationship with a broker in Houston, and he goes, hey, listen, I got this 224 unit. That was 174 in New Braunfels, 174 unit multifamily. He comes to us with a 224 door. And at that time, I'm talking, when was this? 2012, 13, 14, in that area. 224 doors, we bought it for just under $6 million. It was a Class B property. Wow. It was fairly new. And it was, and it's all about location, right? Location, real estate. It was a few miles south of the new ExxonMobil campus that they were building for $300 million. The campus itself, the office complex, and ExxonMobil was bringing over 10,000 employees from all over the country. They were bringing them into this one location. And we were 3 miles south of that property on a direct line on the major highway. So we said, you know what, let's buy it. We went, we bought it, we raised the capital. Now we raised enough to close, but we didn't raise enough to complete the business model, right? Again, we were fairly new. So we closed on it and we started managing the asset. And we had a 3 to 5 year business model that we put together. And in year 2, we got an offer. So we bought it for about $6 million. We put $500,000 into it. In year 2, we got an offer at $9.5 million. We said, no, thank you. We said, there's no reason to sell now. We can wait and we can see the rents going up and so forth. A few months later, the same broker came and goes, hey, how about $10 million? We said, no. How about 10.2? We said, no. 10.25. We got to 10.5 and we said yes.
Love it.
So then we sold it within 2 years and we gave our investors back their money plus, a lot more than what they'd expected because we sold in year 2 rather than year 3, 4, and 5. but with the returns of year 4 and 5 in year 2. So then that pushed up, and just got us going to the
Created
next
more
level.
credibility,
More credibility.
big
and so
win.
forth.
Yeah, that's awesome. So you know what, we were interviewing another guy who's a syndicator, smaller syndicator than you, but it was really interesting to talk about the difference, and you kind of alluded to this, the difference between like buying for yourself, which is what I've done historically, me and my business partner, and we can kind of just at a whim kind of make decisions and just whatever. We need more cash, fine. Him and I just plow it in, right?
Right.
But like when you're buying property with other people's money, I mean, you got to be pretty dead on what's to come, and the business model has to be kind of really hammered out, and you need to give that clarity in the beginning, right?
Oh, absolutely.
And so what do you feel is the difference between like those two different worlds, like the world that I live in now and the world that you were once in, and now you're in the syndication place? Like,
that's a great question.
Yeah.
It's a huge difference, right? Because when you're dealing with your money, again, no one ever wants to lose money, right?
Sure.
I have a couple of rules, and rule number 1 is never, ever, ever lose money. That's rule number 1, right? We never go into a project if we're going to lose money or if there's a thought of losing money. Now, do things go sideways? Things will, it's life. Things go sideways, right? You never know what's going to happen. When you're raising money from other people, you have a fiduciary responsibility to them, right? You have to take care of their money better than you take care of your money.
Agreed.
Right? If I'm losing money on a property, or, I have a single family home and, let's say it's barely breaking even. Okay, you know what? I can keep it like that because I know the equity is going, so I'm not worried about it. But when you promise other people a certain return, and you have to hit certain metrics and whatnot, you're up late at night.
Yeah.
Worrying and figuring out and talking to your partners and doing that. So yes, you can really scale, and that is the way to scale your real estate business, by bringing in OPM, other people's money, right? When you're doing that, you really have to be conservative in your underwriting. You really have to look at plan A through Z. What's going to happen? If this doesn't work, how are we going to pivot? What's going to be the next plan? If that plan doesn't work, where are we going to go? Because you're working with other people's money. And also, if you screw up, they could sue you. They could come after you. I mean, it's not jail time. We're not talking about jail, but you're talking about a headache. You're talking about stress. You're talking about laying out money for attorneys and whatnot, because this is an investment.
And reputation. I mean, how do you go raise another deal if you're getting sued by the last deal that you did, right?
Exactly.
Yeah.
It's reputation. And it's as you guys know, it's a small world, right? It's a huge planet, but the real estate world is very, very small, especially with social media today. There was that guy who lost 3,000 units in Houston last year.
Everyone knows about him.
Everybody knows
That's
about him.
the last deal he'll do for a long time.
He's in India right now. He went back to India, right? I'm sure everybody in his village and his town in India, they know, hey, you were the guy in Houston?
Yeah.
You can't get away from that, right? So it's really, you have to scale it, right? Is it worth the stress of scaling your business and taking other people's money? That's a question that everybody has to ask and answer personally, right?
Yep.
It all depends on your dreams and on your goals and on your visions and what you can do. Then again, you look at a company like Blackstone, right? They haven't always had success. They had to dump $400 million worth of multifamily properties in New York City for $140 million because they saw that they were going to get into foreclosure. So they said, let's dump it. Our investors aren't going to make money, but at least they won't foreclose on us. At least we won't go into that world.
And a lot of times when people look at that, they also don't entirely understand the difference between like a big Blackstone entity and little old us here. We're raising on a deal by deal basis.
Correct.
Versus a big fund. So they can dump $400 million in a $15 billion fund, right? It's like a blip on the map.
And maybe they're having stellar success in Houston and in Charlotte and Atlanta, but maybe they're getting killed in San Francisco and New York. So some of the stuff offsets.
The average is there, right?
Because they're a huge fund.
Right. And they're not, and like you said, Larry, they're not giving the investors on that one particular property. So with us, when we raise capital, we raise for this one specific property. Like now we're raising for this student housing that's a year old, 1 mile from UGA. we're raising for that specific property. So the investors that come into that property, that's what they're getting paid on. And it's our job to hit our metrics. So we're going to be very conservative on that. It's not a blended return, like you said, on this property and that one, and we'll give it. It's based on one property. So it's a different game.
And as for an investor in that situation, it's like the upside is you may really understand that one deal that Nizan's raising on, or really, really like it or feel really optimistic. So the win could be huge, right? But on the flip side, it's not a diversified portfolio that you're investing in, like something that Blackstone would offer. But then again, the return is usually much lower because they just dumped $400 million out of the $15 billion in assets they manage there.
Exactly.
So yeah.
Well, speaking of the anxiety that comes along with that, what are some challenges that you face? We'll get into your successes and your home runs here shortly, but there's always challenges you face, and when you're dealing with multiple deals that you've been dealing with on a regular basis for a decade or more now. What are some interesting challenges you've run across?
So challenges is always in raising capital, right? Well, let me reverse that. So in the beginning, the challenge was finding the right deals, right? And when I got started in the industry, there's the saying that we all go, right? We all hear, find the deal and the money will be there.
Sure.
But no one ever finished that sentence. There's a back part of that sentence that no one ever says. It says, find the right deal and the money will be there if you built the right relationships, right? A lot of people, and I'm also now, I started coaching people to do what I do and to help them build a business around multifamily rather than just becoming a real estate investor. But when you're out there and you're networking, you have to build those relationships. You have to go out there and talk to or kiss a lot of frogs, if you will, so that when you have that right deal, you can now present it to people. We go out there, we're taught, go out and find the deal, go out and find the deal, go out and find the deal. Great. I went out and I found the deal. It was a smoking deal. Incredible. I turned around and I said, okay, where's the money? And all I heard was crickets because I didn't do the back part of that sentence. I didn't build the relationships. I was so focused on finding the deal that I found the deal, but I didn't find the money to go along with the deal. So the first challenge that I had in business was getting credibility with brokers, right? In residential, the credibility comes with proof of funds, with a qualification letter from the lender. You were qualified. We know who you are. Okay, great. We know what your strengths are. We can find you a deal. Here, I'm going out and the brokers are going, like we said earlier, what was the first deal that you've done? Who's your team? Who's this? Who's that? So until we did that first deal in Texas with our sponsor, we didn't have credibility. It was just, it was like the Lone Ranger, me and Tonto. We were just hanging out and right? Who's going to talk to us? Once we did that first deal in Texas, then we had credibility. So now brokers started calling. Hey, I heard you closed on that deal. Hey, I heard you saw this. Hey, this. Plus, we sent out emails to all of our network, to the small people in our network at the time. Hey, check this out. We close on this deal. We close on that one. And that's how we got the second one coming, the one in Houston that I mentioned. The second challenge was raising capital. Where am I going to find? I remember when I was a newbie going into this, I was going to all these conferences and I'm watching people on stage talking. Yeah, we just raised $5 million and I just did this and we just did that and we raised $1 million here and we raised $2 million there. And I'm going, how in God's name are you doing this? What is the secret sauce? What is the one word I can tell people? All right, what can I say to you right now that would take your hand and put it in your pocket and pull out $50K, $100K? What was that secret sauce? And I was running around looking for that secret sauce. I was running around for that one sentence. What is it that people say? How did you raise $5 million? People would tell me, I don't know, I just called people. What do you mean you just called people? What is that? What was it? So moving on and learning, I realized that it was all about building relationships. But it's not just building relationships, it's building the right relationships with the right people. Because when I got started, my mentor was telling me, go to 2 networking events a week and collect business cards. Okay, that's what I did. Not only did I go out to 2 networking events a week, I sent my wife out and I sent her sister out So we were going to 6 networking events a week collecting business cards. I've got shoe boxes full of business cards. Didn't do me any good because these people were not the people they weren't the right fit for what I was looking for. I was barking up the wrong trees. I was going to the wrong networking events. So then I figured, okay, what do I need to do to find the right people? Who are the right people? Then I learned that I had to create my avatars. Specific avatars, and I'm still tweaking them and building them and going. So now I have 3 specific avatars that I know that when I'm posting, when I'm talking, when I'm looking to go into a networking event, I'm going to these specific places to meet these specific people, and I'm using specific language that will hook them and trigger them into going, yeah, that's me. I want to talk to you. So that was a big challenge in the beginning, right? It's still a challenge. Because we're not raising for a fund, we're raising for one-offs, you have to now find the right property that'll match the people that you're talking to, right? Some people want Coca-Cola stocks. Some people want Tesla. Some people want Bitcoin that's going to be extremely volatile, but they can make money very, very quickly. So knowing your avatars, knowing the people that you're talking to, your network, you can now go out and find the right asset that will turn them on and say, you know what, I want to get involved in that. So that was a challenge. And then as I started building my network, I realized that if I'm raising $5 million and it's $100,000 a minimum investment, that means I need to hit a lot of people, right? I need to talk to 200 people to get 50 people to move, or even more than that. And that is a lot of work.
I was going to comment on that. That's when we look at Nizan and we say, oh man, Nizan's got a great life. He's living the dream. And, we think about like, oh, well, I'm working so hard here. But the reality is you need to talk to, it's very similar to like what I do on a daily basis. Sure. You need to network. You need to meet people to sell their houses. Mm-hmm. It's very, very
ABN,
similar.
Baby. Yeah. ABN. Yeah. ABN and ABC.
Yep.
Always be networking and always be closing.
Yep.
Right?
Yep. It's true.
It is. So what I went and I found, and I said, okay, I still have to go talk to hundreds and hundreds of people and build my network. But let me do it a little bit smarter now as well, right? One of the avatars that I'm focusing on is someone who already has a huge network of people that have their ear. So instead of me going out and talking to 100 people, let me find that one person that already has a network of people. An influencer, someone who, someone like yourselves, right? That already you've built your network for your business. People trust you. People know you. They like you. We're here on your podcast. People are listening to you. So now we can come and build a relationship together and build a working business relationship. And then we say, okay, what kind of projects, what kind of real estate does your network like to get involved in? Well, we like 100-unit properties. We like B-class properties where it's this, and okay, great. Here you go. Here's a property. Now you take that and blast it out to your network. So instead of me doing that to 500 people, I can do it to 20 people and talk to 1,000 people, right? Mm-hmm. It's all about the numbers game. So that's what we're doing now. So those have been some of the challenges. Now, that's in acquisition of the property, right? Those are challenges on acquiring the property. Once you close on the property, that's when the fun begins. That's when the hard work begins, because you've convinced people, you've shown people this business model that you've put together, and hopefully it's a very conservative model and you're not too bullish and too aggressive on it so that you can hit your numbers. But then now you have to go and you have to implement that business plan. You've got a property management company that they want to do things their way. You've got the ownership, the general partnership that wants to do it their way. Going, hey, this is what we want. And the management company's going, yeah, but we do it this way. Well, that's great, but we want it done this way. So there's that. Then on top of that, you have the market, the government, the environment, I'm not talking, the environment, the weather and whatnot. I'm talking the economic environment. What's going on? What is the government doing to help move and fund the economy? Are they helping us or are they hindering us, right? We just came out of a 2023 year where, everybody is just thankful that this year is over and we're still alive, right? We're still breathing. We're still, oh my God, what happened, right? And we're going to feel the effects of 2023 and 24 and maybe even into 25 with a lot of foreclosures coming down because a lot of people took out variable loans, variable rates, and that shot up. No one ever thought it would go to where it went. And people going, my God, that's ridiculous. So you have all of those challenges as well that you have to prepare for. And that's why having a winning team, a team of people that understand, that have the same vision, the work ethic, the same ideas of where the ship can run, and you can foresee 25, 30 steps ahead, right? It's playing chess. Well, if this happens, what are we going to do? Well, if that happens, we're going to do like this. And if that happens, okay, where do we go? Do we have enough reserves if this happens? What do we do if rents drop down, if occupancy drops? What happens if, all of the what ifs, you have to really foresee before you even close on the property because you want to build that into your business model. So those are some of the challenges.
And even then, there's things that you didn't foresee, which what I like to call is calling audibles. You know, it's easy to call an audible when, like you said, Larry, it's just you or you and your partner. You can easily do that. You pull a little money from your bank account or whatever it is, or you do a refi or a cash out or whatever it is, or maybe you sell the property early because maybe it's a wonderful audible. You're calling, like you talked about already, that, you know, you had a 5-year plan to exit the property and you exited it in year 2, which is it's a great audible, but there's lots of these audibles you're calling throughout the course of a transaction, I would think, right?
Absolutely. I mean, the world threw an audible a couple of years ago. It was the pandemic.
Yeah.
Sure.
We've never lived through anything like that. It showed me the true value of money, that it's just a made up thing. Right? If the government can tell people, oh, you don't have to pay rent today. You don't have to pay your credit cards. You don't have to
work anymore.
You don't have to do anything.
Yeah, right.
But all you landlords still have to pay. How does that make sense?
Sure.
Yeah.
So how do you, what do you do? Where do you go? And again, that also, so those audibles and how do you mitigate that? By going into specific types of assets that can withstand those types of downturns. They can withstand the 90 days, no payments or whatever it is, right? Because
like a class C or D property, you're going to have a lot of tenants taking advantage of the eviction moratoriums that were there versus if you're in a class B property or certainly a class A, you probably had little or no tenants that were taking advantage of that.
Exactly. It's a different head. Different demographic.
Sure.
They think
Different
differently.
psychology.
Right. The C and D residents, they don't care about their credit scores. Oh my God, I just got a $100 check from the government. Guess what? I'm going to get my nails done. Right?
They live month to month, week to week, day to day.
Exactly. They're in the service-oriented industry. They're not professionals. You go into the B and A assets, you know what? Office closes down. Guess what? I got a laptop from home. I can work from home. I can go do my things. My credit is important to me. I'm going to keep paying. I'm going to figure out what I can do to stay in my house, keep my credit good, because this will end. And when it ends, I want to come out on top, not on the bottom. We're moving into student housing as well. And during the pandemic, a good friend of mine, he had 3 kids in university, one in Boulder, one in Orlando, and one in Tallahassee. I don't even know where they were. And he calls me up and he goes, Neats. He goes, I got 3 college kids living at home now. I'm paying my mortgage and I'm paying 3 rents.
Still.
I'm paying car payments. He goes, how do I get out of it? I said, send me the leases. I'll look at them. I'm not an attorney, but I'll look at them and see if there's, I read the leases. I said, the only way for you to get out of this clean is to pay the rent. Talk to the landlord. Maybe the landlord will be nice. Maybe he'll give you a deference. Maybe he'll give you a break. Maybe. It's all maybes. You got a lease. He spoke to the landlord. He calls me up. He goes, I got to pay. I go, well, you pay or else you're going to get dinged on the credit. And that's the beautiful thing about student housing is that the leases are guaranteed by the parents. So if the student doesn't pay, guess what? You hit up the students. And that's why we're buying A-class student housing for that same reason. The parents don't want to get a call and go, Mr. or Mrs. Smith, we're calling about your son, Johnny, his friend, just put his head through the door and your son's not paying for it. So we're going to send you the bill. And if it's not paid in 2 weeks, we're going to go out and we're going to blah, 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 whatever, it is. And they pay immediately because I can't get my credit dinged, right? So you have all these challenges, and it's important to have a team in place, right? When it's your own property and things go sideways, you sit there and you're like, you know what? Crap, okay, sell it. I may lose money, but we can get rid of it. We can do something really quick. It's mine, and be done with it. In these larger assets, and you don't even have to have necessarily a huge team or be with someone. It's your own deal. You can figure out, like you said, I can call an audible tomorrow and sell it and be done with it. On these larger assets, you got to have a team. You have to have a team, because when you're sitting there on your management calls, you want to brainstorm different ideas. What can we do? How can we do? And then you feed off of any people's energies, right? One person can be, oh my God, we're going to lose everything. And then the other person comes in and says, hey man, we got this. Let's figure out different solutions. Let's figure out. So you really got to have a team when you're dealing with these bigger assets. It's all part of the team.
You make such better decisions when you have other people to, act as a sounding board and brainstorm with you.
What does your team look like? Your investment team.
So right now, we've got 6 people in my company. We got 3 managing partners, the co-founders. It's myself, another gentleman who's been in commercial real estate for 20 some odd years. Started as a mortgage broker, then went as a commercial broker, leasing broker, a sales broker. Then he went into the capital markets division, and then became vice president of capital markets for hedge funds, REITs, family offices, institutional world. The other co-founder, been in real estate for, since 2011. He's a mortgage broker, so he's been in the debt side. I've got another partner who comes to us from the Navy, 15-year Navy pilot, Afghanistan, Iraq, all that. Now think about it. Think about being a military pilot, right? He flew at Top Gun, right? He's one of the Top Gun pilots. Think about the mentality, the type of person that is a pilot that goes through all of that training and becomes the 1% of the 1% of the elite to be able to fly military combat planes, right?
Systems focused, discipline, right?
There is no stopping.
Yeah.
There is no quitting.
There's no failure.
There is no failure. Is blowing up my ship, blowing up the people. Right, is death. Right. There is none of that. So he's our informations officer, and he's part of my capital raising team with me. Right. So when we travel, it's me and him and our 2 other ladies in the company. So we just feed off of each other. And then we have. And that's Brad. Then we have Beth Underhill. She's our chief marketing officer. She comes also 25 years of construction, owns 400 units, multifamily. She owns hotels in Antigua, Belize, and all of that stuff. So she's our chief marketing officer. Then we have Biff Ramsey, who comes from student housing. He managed Blackstone's $1 billion student portfolio for them. So 25 years in student housing, 20,000 unique beds. What does that mean, unique bed? Meaning when it's a unique bed, it means that he rented out 20,000 individual beds, not to the same person, right? Because people renew. That's not part of that 20,000. That's unique beds. He's gone full cycle on 18,000 beds, been an LP and GP on 1,000 beds himself. So he comes to us from student housing. He's played with Blackstone, Landmark, all the big players. He's worked with them, managed for them, work. So he knows, he's our operations guy. We close on a property, we give it to Biff. He's got his operations team. And just to share with you, the 2 other student housing projects that we bought came from him, from his connections. But while we were under contract, we gave our business model to the current property management team, because in student housing, you're leasing up today for next year. It's not like multifamily. A lease comes in, okay, 30 days, they move in, and it's just rolling. We're leasing up now for next year. So when we were under contract in our due diligence, they started leasing up. It was leasing season during our due diligence phase. And, when an owner starts to lease, they're like, okay, we'll just lease, put another $50 on the renewals, whatnot, just to get heads in beds and be done with it. We said, no, we can't afford that. So we gave them the business model. So in one property, we wanted to take the beds to about 740, 760. We're at 910. right now. So I'm sorry. They were leasing up at 700. We wanted to take it to like 740. We gave them the business model. They started leasing up. And while we were under contract, they were already exceeding our pro forma numbers in the lease up. So when we took over, we were already above our pro forma numbers, our business model. We were proving our model during due diligence. The last one we just closed in August, that was 252 beds by Middle Tennessee State University. Down the block, literally across the street from it, I went to do the walkthrough inspections. I walked every unit. And I was sitting in the clubhouse and, the leasing office, and I'm watching students with their parents walking in and just one after another, sign a lease. Our goal was to take the rents also in that property to about 760, 770, 780 at that time. We gave them the same thing. We gave them our business model. They started pushing rents to 760, so we were hitting our pro forma numbers. Mm-hmm. I'm in the office and I'm looking and I'm talking to Biff. I go, Biff, how many more units we have to lease to renew for next year, pre-lease? He goes, about 50 out of 250. So we've got majority of them. And this is a 20,000, 30,000 student school. We don't have 1,000 beds. We got 250 beds on 20,000. We need another 50. I said, why don't we push it to 800? Worst case scenario, the leasing agents, they say, oh, we don't want 800. We'll do 785. We'll give you a discount. We're still beating our numbers. He told the management company, and the last 40 or 50 units, they were starting to lease at 800. So now we're leasing at 860, where our NOI is 18% higher than it was when we took over. So just having the right operations team in the right asset at the right location at the right time is gold, right? So that's Biff. And then who am I missing? So it's myself, Charles, Russell, Beth, Brad, and Biff. That's the core MTN investment group. And then we have an executive employee. Her name is Katie. She's our investor relations.
Great.
So she takes care of our investors, white glove. So that's the team, right? So now I don't have to worry about operations. I don't have to worry about filling out 14 different applications and putting in forms I can focus on what I do best, which is going out there, networking, talking to people, building relationships, bringing them to the table. And when you have other people on your team, it's a volleyball game. I edify you, you edify me, we edify Larry, and everybody's happy. People going, dude, this is a great team. I want to be a part of this. And that's what we go out and that's what we do.
It's great. Yeah, it sounds like you put a really impressive team together. A lot of people with a lot of hefty industry experience.
Absolutely.
So good stuff. Mm-hmm. So tell us, let's fill in some of the gaps too. So I think we left off after your second property, and we know about your most recent Georgia property, and I think you just briefly mentioned your your Middle Tennessee State property. Mm-hmm. But what are some other deals that you've been working on the last 5-6 years, and also geographically, where are these properties and why?
Sure.
Are they in certain areas?
So when I got started in multifamily, and go to all these different boot camps and watch all these people on stage, everybody was talking about Texas. Dallas is the best market, And it's funny because after every one of these 3-day boot camp, everybody in that room now calls all the brokers in Dallas. So they know already. They're like, oh, did you just come out of the Dave Lindahl event? Did you just come out of this event? Did you just come out of that event? Well, why do you say that? Because 45 people just called me, gave me the same script, right? So we started out in Texas. We bought in Dallas. We bought in Houston. I bought in San Antonio. So we had a big portfolio and went full cycle on that. And now we're, the Sun Belt is where people, it's great because when I was getting involved in multifamily, the Sun Belt was cheap. Dallas was still cheap. Florida was somewhat cheap. Carolinas were cheap. Tennessee was still cheap. Now, thanks to the pandemic and whatnot, this whole area is just, people have been
inundated with money.
Just coming down. Sure. Prices are going up. I'm getting multifamily properties, as you guys know, probably in Miami and like Little Havana and whatnot. 1920 build, and they're asking $300,000 a door. I'm like, dude, I could build for less than that.
Right.
And where are we going with that? Do you think somebody's going to buy it from me for $400,000?
Sure.
Right.
Like what's,
Where does it end? Yeah.
where does it end? Where does it go? So I, of course, you always want to look in your backyard. That's the, close and easy, and it's in your backyard. But my backyard was way too expensive because I'm using other people's money. I got to give them a nice return. Mm-hmm. How can you give somebody a return when you're buying a property at a 3 cap, right? And your interest rates are even higher than that. So there's no meat on the bone. So I was, Texas, Tennessee, all the way up, Georgia, northern Florida. We're doing a hotel to multifamily conversion in Kissimmee right now.
Very cool.
That is cool.
Which is great because when you do that conversion, you have a fairly new property, right? The bones, the concrete is still old, but the pipes, the flooring, the kitchen cabinet, it's a new property, basically. Yeah. So we're getting a new property for way less than what a Class B or an A- property would sell for. And there's still a lot of meat left on the bone. So we've been dealing with that for about a year and a half with the city and the county and all of that. But we're going, Georgia all the way up to North Carolina. I've got one new market that I've been very, very bullish on for the last 2 years. Not going to say where it is.
Somewhere in the Sun Belt.
It's actually out of the Sun Belt.
Oh, is it?
It's in Northwest Arkansas.
Okay.
I was going to say, I think I could guess it. There you go.
Northwest Arkansas, per capita, has the most construction cranes up and running anywhere in the country. Okay? And the reason why? You got Walmart. You got the Waltons. Yeah. They're throwing They're throwing a ton of money into the economy because they understand. You put art, you put museums, you put culture, then the money comes. The money comes, then infrastructure comes. Then companies come, then businesses come, right? Why is Boca booming? Because of the Economic Development Committee. Jessica Del Vecchio, for the last 10 years, has been doing an incredible job bringing in corporations and headquarters of companies into Boca. Are they giving them tax incentives and whatnot? Absolutely. But when you bring them in, it creates jobs. That's the golden, the holy grail is job growth, right? So the Waltons in Northwest Arkansas understand that. And they've built these beautiful Class A museums and art galleries and whatnot, just phenomenal stuff. Plus, Northwest Arkansas has over 500 miles of biking trails. You have concrete bike trails, dirt bike trails. People from Colorado, people from California come to Northwest Arkansas to go dirt bike riding. Now the Walton boys, they're big into biking, into dirt bikes. They're throwing a ton of money wanting to make those trails world-class trails. So you've got all these things coming in. Now, what people don't know also is with Walmart, that's the headquarters. If you're working with Walmart and you have product on a shelf on Walmart, you have to have a main headquartered office in Northwest Arkansas. So as Walmart grows,
so grows everything else.
So grows everything else in the economy and whatnot.
I was at my gym earlier this week, and one of the guys I work out with, he was just telling me, he said, we were just talking about our weekends, and he's like, yeah, man, I got to get back in the gym. I had a rough weekend. I said, where'd you go? He said, I was in Bentonville. He said, I ate at some of the best steakhouses and
Great
the amount
food.
of drinks I had. I didn't even really ask him. I kind of know his business, and I think he was probably there to be getting his products on the shelf and selling to Walmart. And the amount of that kind of traffic that comes in and out of there, whether they live there or not, I'm sure it's great for hotels, for hospitality, for all of that. It all just kind of grows.
There's a big crisis going on in Northwest Arkansas, in Bentonville and in Rogers especially, with short-term rentals, right? Just like it happened here, a lot of parts of the country. People are buying houses and apartments for short-term rentals.
Airbnb, yeah.
There's no more homes. So I was sitting, when you do your due diligence in the market, you want to meet with the Economic Development Committee, the Chamber of Commerce. So there's one guy that runs both. So I sat with him and I met with him and we sat for an hour and a half and he shared with me everything that was going on. And he says, we had the committee together and we posed the question. There's not enough homes for renters because they're all being turned into short-term rentals. So what do you do when an economy is booming in that certain niche? Do you stifle it? Do you limit it? How do you work around it? And they go, well, the best way to solve progress or to solve for progress is to have more progress, build more infrastructure. You don't stifle them. Just go out and give people, make it easy for people to build and to grow and build more infrastructure.
The other big cities in the other states, they're trying to lock down Airbnb and ban it. And instead of saying, let's build more. There's a need for Airbnb, but there's also a need for more housing. So let's build more.
Why stifle it? Make people pay taxes on it. That's okay, but at least regulate it, make it and expand it so more people can come, right? For an economy to be robust and for people to make money, you have to build the infrastructure. You have to make people want to come live there. And it's all about job growth. And when you have tourism builds jobs, right? When you have jobs, then you need schools to house the people who are building the restaurants and the coffee shops and the laundromats and all of that, right? They have families. Now you have schools, you need playgrounds, you need amenities, so it just feeds that economy. I don't understand the people in power in local governments and whatnot that really want to keep it low, want to keep it down. Here in Boca, we've experienced immense growth. But I think it's been one-sided. The infrastructure in Boca has been halted. They're not building streets. They're not widening streets. They're not doing anything to facilitate movement of traffic. But what are they doing? They're building like crazy. There's more people here than there were 10 years ago. But you know what? Federal Highway is still 2 lanes at 45 miles an hour. Right? Mm-hmm. It takes me now 15 minutes to get from my home here when 10 years ago it would take me 3.5 minutes. And it's just because the amount of people waiting at the stoplight. Mm-hmm. Right? So they're not building that. So Northwest Arkansas is another one. Another place, it's a little far from me, but another market that is booming that you don't really hear about it is South Dakota. Mm-hmm. South Dakota was open the entire time during the pandemic. No face masks, no sitting outside, none of that. But nobody ever talked about that. Tons of people went there, and South Dakota is a booming economy. So, we look in the Sun Belt, but as the Sun Belt starts getting hot, funny, as the Sun Belt starts getting really, really hot, you got to start looking for other places to go.
Salt Lake City, Idaho, Wyoming, Jackson Hole,
all those places.
All those people are moving there too. It's not just the Sun Belt.
The millennials are moving there because the cost of life is cheap, and they can work from their laptop. They can sit outside on their van, looking at a beautiful mountain, and work
with their 6-foot dreadlocks.
Exactly.
Not that you would know anything about that.
I wouldn't know anything about that, but and again, that's kind of my goal. That's where my destiny is headed. I don't know where my destiny is, but that's where I'd like it to go. Once my 15-year-old is out of high school and she's doing what she wants, college, travel, whatever, guess what? That goatee is coming back, buying that van, getting my laptop, setting it up, and I'm on my merry way. Love it. That's why we do what we do.
Yeah, freedom.
It's freedom. It's not about the money. I don't care if it's about the cash flow. The cash flow and the ability to be able to pick up when you want and go wherever you want for as long as you want. Right? That's why we're doing this. And I was talking with my wife and some of my partners. I said, you know what, man, this year has been so stressful for me. I don't know if I want to continue doing this next year. And then, and because you're looking at the stress level and why are we doing this and this and then I get an email, National Multi-House Conference in San Diego. So I'm talking about, hey, we got to go to National and we got to, and I say, wait a minute, didn't I just say I wanted to take it easy next year?
It's an addiction,
right?
Larry and I joke about this all the time. All the time.
It's like, wait a minute,
real estate's an addiction.
I want to chill.
Yeah. You're like, I'm in rehab and no more real estate, and then you see that property that just has the sizzle and the numbers, and you got to load up your veins again with more.
It's like, wait a minute. I can't.
This guy's on vacation calling me like, hey man, can we put this under contract?
Just throw an offer. Just put an offer in. Yeah.
I thought a week ago you said you're stopping.
That was 1 week after,
right.
6 months. I'm just gonna pack up a lot of dry powder and
just go.
Yeah.
I told my team last year when we closed in December, when we closed on Milledgeville on the Boulevard, I told my team, I said, look, come November 20th until January 5th, I don't want to deal with nothing. I am out. This is how I want to build my life. I want to hang out for Thanksgiving. I want to chill, Hanukkah, Christmas, New Year. I don't want to worry about nothing. Well, that didn't work. That didn't work. We closed on a property in August. Now we're raising for this one, and we're closing on next week. I just closed on I sold a duplex, and I still do duplexes. I had a duplex in Lake Worth, sold that one, closed on it yesterday.
Nice.
Thank
Congrats.
you.
Yeah.
I've got we put our 64 unit Section 8 property on the market, and the guys, I mean, incredible. You know, sometimes you got to get lucky with buyers as well. These guys came in, they did all their due diligence beforehand. They talked to the city, the state, blah, 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 and figured out what grants and what money they were able to get from renovations and Section 8 and all this. They came in, they did their due diligence in 2 weeks. That was 4 weeks ago, and we're closing by the end of the year.
Amazing.
Because they want to close because they need to get their grants in, blah, 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 blah. So that worked out great. So we're giving our investors, again, this was a 5-year game plan. They're assuming the debt as well, which was 3.5% interest with another 7 years on the note.
Amazing.
So they're getting in good, and they're making their above returns of what we projected for 5 years, but now in year 2. So they're happy. So that's going on. So what my plan was to have a nice, quiet end of year kind of flow into the new year. Just that's not happening.
But
you
for
know
good
what?
reasons.
Thank God.
It's not like you're giving properties back to the bank or, you know.
Thank God.
Yeah.
Right.
So these are good things.
We got to look at our blessings. We got to look at what we've got, you know. Thank God. Right. Thank God I'm not pulling my hair out, losing properties and doing all that stuff. You know, there are properties that aren't doing as well as we wanted to, that they need help and whatnot. There are a lot of groups out there doing capital calls. It's part of the business. You know, when I got into this business, I said, I never want to have a capital call. I never want to do that. I never want to be that guy. Okay. To date, we haven't had a capital call. Thank God. Right?
And for the audience, capital call is where you need extra money, capital to be injected into the deal because maybe the numbers you have pro forma, they're not working out. There's been extra expenses, insurance goes up, or you've had some major repair, or an event, a fire, or flood, or something like that.
Pandemic, people aren't paying.
Yep.
You know,
and you haven't had that, so that's awesome. Good.
You know, so right, you know, so we've had to, you know, figure out different workarounds and whatnot. But you know what? It's part of the business, and that's why, you know, in syndications, you have different levels of investors, right? Like Bernie Madoff, for example. He went and he raised money from what we call the man on the street, right? The person on the street, mom and pop. That this is my last $5,000, and if I lose this, I can't eat tomorrow. We don't talk to those people. We don't, you know, don't even look at me. I don't even want to hint that I even mentioned an opportunity or an investment to you. So those people we don't talk to. Then there's these other two classes of people. One is the sophisticated investor, right? And it has to do with income levels, right? What your income and net worth is. So a sophisticated investor doesn't match the criteria of income and net worth, but they own a duplex. They've invested in stocks and mutual funds. They have a financial advisor. They understand the risk. They're in business for themselves. So they're a sophisticated investor, right? Then you have what's called an accredited investor. An accredited investor is someone who makes $200,000 a year singularly on their own, or $300,000 combined with their spouse, or a net worth of $1 million or more, not including their primary residence. That's an accredited investor. So when you're raising capital, you can raise capital from those two groups of people, right? There's one regulation that's a 506B that allows you to bring in accredited and sophisticated investors. The thing with that is that you have to have a pre-existing relationship with these sophisticated investors. What does that mean, a pre-existing relationship? The SEC doesn't have a set format of, you have to talk to them 3 times for 20 minutes before they get to invest with you. There's no definition of what a pre-existing relationship is, right? So you can go and you can meet someone today and talk to them tomorrow, and next week hit them up again, and then put a property under contract and say, hey, Jerron, listen, we just met last week or 2 weeks ago and blah, 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 blah. Here's an opportunity. If I have a property under contract and I meet you today, you can't invest in that project because we don't have a pre-existing relationship. And you can only get, I think, 35 sophisticated investors or something like that into that. The other offering is a 506C, which is accredited investors only. Oh, and by the way, the other one, you can't advertise. I can't go out there and shout, hey, everybody, I've got an opportunity. Let's go play together, right? You can't do that. Accredited investors, the 506C, you can put a billboard up on I-95 going, $100,000 investment will yield you 2x multiple. Call me, right? You can do that, but you can only bring in accredited investors, right? And when you're doing a huge raise, 5, 6, 7, 10 million, you want to do accredited investors only because you want to go out there and meet these institutional players that will come and give you a $5 million, $6 million, $10 million equity check. You may not know them now, but by doing your due diligence and raising capital, you'll meet them and you'll be able to bring them on. So,
Plus, it's also, I'm assuming, a lot easier to manage, let's say, 10 investors as opposed to 35 investors.
Absolutely.
Throughout the course of a 5-year project. Because you naturally will have those investors, especially those that are not accredited, they're not making that $300,000 minimum per year in their cash flow income and
Correct.
have well over $1 million in assets. They are more likely to want to get some of their money back because maybe they're going to have some financial issues, or maybe they lose their job, or whatever the case may be, where that's probably a little less likely with those accredited investors because they have assets to pull money from, and they're probably not going to beg for their money back in year 2 when you have a 5-year commitment from them, right? Am I
absolutely,
okay.
Absolutely. And the accredited investors are not going to call you every other week on, hey man, how's my money?
Right.
What's going on? How you doing? Hey, right?
They don't need the money.
They don't need the cash.
They
flow.
want the money,
right?
But they don't need it.
They probably don't have time to deal with that.
Exactly.
Anyway. Yeah.
And a lot of times, a lot of the accredited investors, yes, they'll put their money in because the deal is great. They have to place money, like these institutional investors and whatnot. They have to place the money, so they'll put it. But when you get the one-off accredited investors and whatnot, they'll put the money in. Yes, they want the cash flow and they want the appreciation, but what they're doing also is they're creating paper loss for themselves. They're creating depreciation, right? A lot of these accredited investors have passive income coming in, and they're going, you know what? Let me take $500,000. I'll put it in there. I'll get my paper loss, put it against my other my passive income. Now I just minimized my tax liability, or I deferred it for 1, 2, 3, 4 years. And then when that comes around, we'll defer it again and keep going. And that's why when you're flying down A1A or you're going down the intercoastal, you see all these big yachts and these big homes that people don't live in them. And you're going, what's the point? Why are they buying all these homes or these yachts? Well, they're buying it for the depreciation. Think about Trump, right? He's making $100 million a year. And then he goes out, however much money he's making. Then he goes out and he buys a $100 million boat. Does the guy need another yacht? No. But that $100 million yacht will give him $50 million of depreciation or whatever it is. So he'll take that, put that against it. So what did he just do? He just bought himself a yacht. Okay, right? But he which adds to his net worth as well. But also he's able to depreciate that boat and put it against his income so he doesn't pay taxes. The tax code is there for us to minimize our tax liability.
It's ripe for the picking. And I said that too, is like the first part of your career is focused on growing your income.
Right.
What can I do? How can I grow my business? How can I, if you work for a company, how do I move up in the ranks? And I want to go from entry level to VP in a 10, 15-year career path, and I want to make more money. But at a certain point, you shift gears once you start to make a pretty decent amount of money, and you say, now, how do I pay less taxes?
Exactly.
And that's the new game, and that's the game that these multimillionaires are playing, is how do I shield my money from paying the IRS and pay them the least amount possible, legally, of course.
Absolutely.
And use all the tools that are in the toolkit to do that, and real estate is one of the best ways to do that.
Real estate is one of the best ways to minimize and defer your tax liability. Bitcoin, crypto, doesn't have that. Stocks, bonds, mutual funds, doesn't have that, right? What else is there? What other investment vehicles do we have? That's it, right? When you talk to someone, oh yeah, my money is with my financial advisor, it's on Wall Street, it's this, that, and the other. Okay, how are you going to take depreciation off of the money that you just made on Coca-Cola? Well, you can't. You got to take that profit and put it into real estate, or buy an asset, buy a car, buy a plane, buy a boat, something that you can depreciate, right? And real estate is just, when you're buying cash flowing real estate, you get what I call the golden trifecta. You get cash flow, appreciation, and depreciation. Where else can you get that?
It's very hard. It's very hard. Yeah.
Yeah. I agree. That's why we're in it.
That's why we're in it, baby.
That's why we keep the needles going in the veins.
That's why we're in it, man. That's why we're in it, you know?
And it's a winner.
Beautiful. It's a beautiful thing, you know? And it helps you build wealth. It helps you keep more money in your pocket. And again, the tax code, the 10,000 pages of the IRS tax code. Now, I'm not a CPA, not a tax attorney. That's a disclaimer. But, you know, those thousands and thousands of pages are written for you to take advantage of the tax code and minimize your tax liability, right? It's written for the people who take risks, right? The guy who starts a hospital, the guy who starts a business, who opens up a coffee shop. It's there to incentivize us to go out there and build and open up businesses, right? The person who comes in, and don't get me wrong, you know, everybody has their role. Everybody has their place. You know, we have, you know, if everybody on the planet were multimillionaires, like, Jerron, I'll give you $10,000 to go get me a cup of coffee.
Exactly.
Yeah.
Right.
We wouldn't have that, right? And there are people that I know, a lot of my friends are like, dude, you know what? I don't want that headache. I want to wake up in the morning. I know where I'm going. I know what my job is. I love what I do. I love the people I work with. I come home. It's quiet.
Yeah.
It's quiet, right? We're at home, entrepreneurs. There's no closing the shop. Even if you're a coffee shop owner, or a store owner, or business owner, you can't turn it off.
My wife told me again this morning, I woke up, and when I wake up sometime between 2 and 4 a.m., I have to walk out to the couch because I'm just up and I'm thinking. And the first business thought that goes through my head wakes me up. So I go on the couch, I send myself notes of things to do, and then maybe I do have a little idle time and go on Twitter. And then maybe I'll fall asleep again between 5 and 6 a.m. And then I'm up, and it's bad, you know, the lack of sleep. So there's great things about entrepreneurship. I've got a flexible schedule. I don't need to clock in at 8:30, but there are those downsides, and the weight of the business, and feels like the weight of the world is on your shoulders. So I know you know that.
Oh
that
yeah, I battle with that. But you know what solves that too, or helps solve that, is a good team. To your point earlier. I mean, when you know, like, X person has got things under control.
Got your back.
Yeah, it's just like, okay, at least that's one less thing that I have to stress about.
Right.
For me, what keeps me up is like the level of uncertainty around something we need to execute on, where it's like we either haven't done it before, or the people I have in place to get it done, it's just like a big question mark if they're doing it correctly, or if I'm going to have to find time to go help them solve what they're supposed to solve, whatever that is, right?
Sure.
So, yeah.
And it's along those lines. What happens a lot of times, it triggers something. I'll wake up, and then I'll instantly have a thought of something I hadn't thought about that new project we're working on, and it's a detail. And until I go and get it, notes sent to me, you know, on my phone, like
go to sleep with
I
that.
can't go to sleep
Yeah, I
without
have the same
that.
thing.
And then I'm up and whatever.
Yeah.
But enough about my sleep. But so
Tell us more about that.
nap here, guys. Wake me up.
How do you really feel about that?
So let's talk about two different things. I think people who are watching this, one set of people could be people who maybe they want to, I don't know, dabble in syndication or get their feet wet or put their toe in the water about that. How would that look to them? And then the second question is those people who maybe have some capital sitting on the sideline, they're working hard at their business, they're doing their investments in their 401k or the things they know about. Maybe they're dabbling in real estate with a few little investment properties here and there. How would they invest in a fund such as yours, and what does that look like? So kind of those two, the sort of the GP route, getting their feet wet in syndication, and the LP route of what does that look like?
Sure. So, you know, when you're starting with a GP, and we just talked about it's about the team. Mm-hmm. When you're starting out, and a lot of my coaching clients, they have the same thing happen to them. You know, you're sitting behind a desk, you're sitting in front of a computer, and you're traveling around the country. You're looking at properties in this market, you're looking at properties in this market, you're shooting an email to this broker, to that one, you're underwriting, blah, blah, you're on social media, you're watching what everybody's doing. You think you're out there and people know who you are. People, oh yeah, I know Nizan. Oh my God, yeah, Nizan is sitting in Boca at his house, in his room, and the world is watching me, right? Nobody's watching me. Nobody cares about me. Nobody cares about what I'm doing or who I am. So it's going out there and building that team, right? You have to have a team in place, because when you're going out there, when you're building the relationships with the brokers, right? I tell my coaching clients this all the time. When you're starting out and you're underwriting and you're analyzing markets and you're analyzing deals and you're submitting letters of intent, what happens if your letter of intent gets accepted?
Yeah.
Then what?
Things happen fast, right?
Right.
Yeah.
I go, then what?
Yeah.
So when you want to, you said when people want to dabble in syndication, don't dabble in it. There is no dabbling. You can't really dabble in syndication.
I think that's the answer. But
Right?
people will ask that question,
Right.
but that's
there
the
is
answer.
no dabbling in
There's no
syndication, because if you dabble with it, you're trying it. And when you try something, you'll pretty much not succeed because you're trying it. And you go, oh, it didn't work, whatever.
Right.
And if you're dabbling in it, means that you're not 100% in it. You're not 100% committed to it. And you're leaving the back door open. If something happens, you're like, you know what? I'm out. So if this is something that you want to do, then find a mentor. Find someone who's done it before, right? Because you're going to need a person who's done it before on your team for a couple of reasons. One, you want a sounding board. You want someone to tell you, hey, don't go over there. I went there and I scraped my knees bad, so don't go there, right? Then you need somebody on your team who's going to be your sponsor, right? Not your AA sponsor, but your key principal is what they're called, right? Someone who has the track record, liquidity, and net worth to be able to sign on the $5, $10, $15 million loan that you're getting, right? If you're a newbie and you're sitting behind a desk and you've never done a deal before and you're talking to a mortgage broker and you're saying, hey, I found this deal, I need $5 million from you and I'm going to raise $3 million from equity, the mortgage broker is going to say, okay, great. What's your portfolio look like? What was the last deal you've done? What's your net worth? What's your income? Are you able to pay 9 months worth of debt service, of mortgage payments, if there's no cash flow? You go, right? That's when you start to stutter. So you need to find that person. So when you're getting started in multifamily, you need to get educated. You need to learn the language, the lingo, right? Because the broker is going to call you, and when you're talking to them, they're going to go, so Larry, what's your going in cap rate? I'm sorry, what's the what? What's your going in cap rate? What's your yield over cost? I want a 7 cap rate. And I go, well, you're asking me or you're telling me, right? So you need to know the language. You need to know what you're looking for. So you got to get educated. You got to build a team, right? You got to have that sponsor. Have a mentor, man. Have someone or a coach, someone that'll teach you how to underwrite, how to look at a market, right? I was talking to we have a group coaching every Wednesday night. I have my group coaching call last week. One of my students on the call, one of my clients, she goes, so underwriting is just taking numbers and throwing them into a spreadsheet, right? I said, that's exactly what it's not. And I said, wait a minute. If you're asking that question now, I'm not doing a good job as your coach, because that is absolutely not what underwriting is. Underwriting is understanding this side of the street versus that side of the street. Understanding where the sun rises and sets and how that affects your property and affects your sunlight and whatnot. Understanding what the flux of movement is in that market. Is winter in that market the death of you? Or is it the best of it, right? We're in Wichita, Kansas right now. We bought a property. I'll give you an example. And we just moved into that market. That's a fresh market that we're in. We didn't realize how badly the winters were over there. Now, I don't mean with the snow and whatnot. I mean by the movement of people. A lot of people move out. A lot of people don't lease up in the winter. There's not a lot of movement. We had a lot of leases come due in the winter. And we realized, oh my God, we dropped down to 88% occupancy. Well, we got to pick it up, move, do this, do that, blah, blah, blah. We picked it up again. Went through another winter, saw the same trend. Now we said, okay, how do we fix this?
Yeah.
We can't have leases coming due in winter. So now we're going to have 6-month leases so that we're going to lease up at a certain time so that they're in during the winter, and in the summer, their leases will come due because there's a lot of movement.
We do the same thing in South Florida, right? Like there's like an optimal time to lease, and we try to rearrange things so that they all kind of hit in a certain timeline.
Because
it's a real asset in the real world. You need to understand how that, when you underwrite, that's what you're thinking about, right? Like you said.
Exactly.
And
That's
people don't
underwriting.
appreciate that. Yeah.
That's underwriting.
Yeah.
That's knowing. That's building for that movement, for that change, right? It's not just taking numbers and throwing it into a spreadsheet. It's understanding what the millage rate is and how to do it. I had a call with one of my clients last night, and we were going over the millage rate in Bentonville. And we pulled it up, and it said 51.6%. So he underwrote it, and he goes, "Look, man," he goes, the
taxes are so high.
Taxes are $120,000 a year. He goes, "It doesn't make sense." I'm like, that
Divide by
that millage rate is not. It just doesn't sound right.
Yeah.
51% of the assessed value. I said, let's look. So we did some research together, and I said, all right, dude, it's not 51%, it's 0.51. That decimal point. So now it went from $100-something thousand to $40,000 or $50,000, and now it made a little bit of sense. So that's also part of underwriting, understanding, not just taking an insurance number and throwing it in there, but having an insurance broker on your team that you can call up and go, "Hey, Jerron, listen, I got this deal. I'm sending. Give me a quick quote, roughly." 20,000, 50,000, 100,000, where are we going to be? Okay, great, I got that. Knowing what your real estate taxes are going to be. Calling the city and talking to them. How do you assess a 1-year-old property when you're taking over? Is it, do you assess values every 3 years? Do you assess values every purchase? When you exchange deeds? How do you assess that? How do you understand what's the job growth coming in? How many people, right? So that's underwriting. You really have to understand
making sure that your insurance quote matches up to what the requirements are of the lender.
Exactly.
You have to be communicating with those two parties because maybe they'll give you a quick quote, but you're not buying it cash. You're buying it with financing, and do you need wind or not, or what are the
Is it
policy
a $3 million policy and the lender wants $5 million?
Changes your numbers pretty quick. So.
Absolutely.
So I would just add one or two other things to that, just from my experience with syndication, that one of the best things to do, well, two things. One is, you mentioned it already, get education. Go to one of these courses.
Yep.
There's a number of them out there. I've been to the Rod Khleif one. It was very good. There's at least a handful of nationally renowned teachers and mentors that are out there that give these courses. Start with that. Start with a weekend course, I think is great. The other thing too is start as an LP investor.
Sure.
Put one
Absolutely.
LP investment in, put 50,000 in, or maybe you can go as low as 25,000. Maybe someone will let you in to a deal for something small and get exposure to that.
Right.
And then that also helps you to build your resume as well, because maybe you're a small participant in a 400 unit apartment complex. Well, you can put that apartment complex on your resume that you're an investor. You're not a GP, but you're an LP investor in that. And all those things on your resume add up when you're talking to brokers in the future. So I would just kind of wanted to add to that. And then what about for LP investors that are looking to get in and get some passive income? What does that look like?
So again, you got to look at the team.
And you still need to understand what the heck you're doing if you're an LP investor, right? I mean, and that goes back to, like, an LP can make you a GP, right? But like the guys that I know that are LP investors, they spend a lot of time looking at a lot of different deals and trying to understand them. Right. I mean, like,
and the differences between them. Yeah,
right. Exactly. And then who to go with, who to work with. There's a ton of syndicators out there, right?
Ton of syndicators, ton of people. There are there are LPs who became syndicators who are now saying, "Oh, I'm in 1,000 units." Well, yeah, but you're an LP and you have no knowledge of the inner workings of the day-to-day management of the property.
Very different experience. Yep.
Very different, right?
Sure.
So again, as an LP, you want to look at the team. You want to look at the executive team that is running the ship. How many deals have they gone full cycle? What was their, how do they communicate with the investors? Who are they? Do they have enough liquidity? Do they have enough this? Have they, right? So you want to do your due diligence on them as well. But yes, as an LP, go into something that you understand, that you like, something that will, if you're starting off, again, it also depends on your appetite, right? If you're a risk taker, you're like, yeah, dude, okay, go into a high risk situation. I'm not a high risk person, right? I don't like that. I don't like it when things keep me up at night. So I want to go into a conservative deal. So I would look at, okay, what is the underwriting, right? How are they conservative? If they're telling me that there's a $400 upside, are they telling me that they're going to do it the first 6 months? Right? Because you have operators that are extremely aggressive. Oh yeah, we'll take the rents and we'll bump them up, and the first 12 months we're going to take it and we're going to, turn over the entire property and we're going to occupy it and we're going to do this and we're going to raise rents and blah, blah. You know what? That's aggressive. That's aggressive because things happen, right? When you're sitting in front of your computer and you're creating your business model and you're looking at the rent roll, you're going, okay, so there's 100 units. You know what? I predict that when we raise rents, a lot of the people aren't going to renew. Well, okay, and when you renew, you may not, and there's a huge increase. Let's say there's a $400 increase. You got to go in and you got to throw a lot of money in that renovation.
Turn costs
to make it go. A lot of times, the tenant will go, listen, I just want to renew my lease. And you're going, okay, I didn't expect you to renew. I expected you to leave. That now changes your business model, right? So you really want to understand and make sure that you're getting into a deal where the ownership team understands conservativeness. They understand that, where are the buffers, right? How much buffer zone did they put into the deal right? The last 2-3 years, right? You're looking at underwriting where people are going, okay, we're increasing rents by 7 to 10%, and we're only increasing expenses 3%. And now, still today, you see that increase of that difference, and you're going, that's super aggressive, man. That's very aggressive. How are you going to do that, right? Well, we're gonna refi in month 12, and we're gonna do this, and it's, you know what? The real world is a lot different than paper, and if it's a little too aggressive on paper, I would be careful with it.
I mean, we've experienced this in our own investing. It's just like we underwrote. We're pretty conservative too. So me and my partner. So we've underwrote a lot of deals, and they've outperformed dramatically, right? And that's what a lot of syndicators are seeing too. And some of those syndicators underwrote stuff super aggressively and they still outperformed or they hit their targets.
Right.
And in today's world, I question if that gets done the same way. If they're still operating, or if they're still underwriting the way they were 3 years ago, to your point, or 5 years ago, or 10 years ago, I'm like, I don't know about that, right? And so that's exactly what you're getting at. So,
and that's why we moved from the B and C properties, where there's a lot of turn costs, a lot of CapEx renovations. We're now moving to the A properties where it's just management inefficiencies. Because if I need to take time now to renovate, I don't know what's going to happen at the end of that time span, right? Where's the market going to be 6 months, 12 months from now after I've renovated? Will rents still be going up or will they drop down? And if they drop down, oh man, we just put a ton of money into this and we can't hit our goals. So we're now buying these properties where we know that there's a lot of management inefficiencies, and all we have to do is say, Mr. and Mrs. Resident, look, you can leave. You can go next door and pay $1,500, or you can stay here and pay $1,450. Yes, it's a $500 increase, but you're going to have that $500 increase wherever you go. So you're going to have to pay for moving. You're going to have to pay for moving costs, security deposit last month, blah, blah, blah. You're going to have to clean up this space. So why go through all that? You're going to have to pay for your background checks, your admin fees. You already did that. So why not just stay and your rents will go up? And you know what? We probably won't go as high as our neighbors, $50 below, just to give you another incentive to stay. That's what we're doing. So it's a no-brainer, and it's a quick turn.
And when you're in the game so long and you've done so many deals, you kind of can pick the niche that works for the marketplace at the time, right? And that's kind of what you're doing here. You're like, hey, we're really tight on the operations, and we see that inefficiency, and we know we can handle that because we've done it X amount of times before this. And so if you're using the same playbook, again, like that's where, when thinking about being an LP, is how I would look at the team, as you said, and their track record, and the deal in place and the current market right now. That's how I would kind of think about that. Because I mean, that's a perfect example of like, setting yourself up for success versus winging it on a bigger, riskier deal that might suggest a lot more upside. And they might get it, but they might not.
Right.
So.
And, so multifamily these past year, 2 years has been sketchy, right? Interest rates went up, prices didn't go down, right? And, for people listening, right, you have this metric, it's called a cap rate, right? It's the ratio between your net operating income and the purchase price, right? So a high cap rate means that you're buying a cheap property. You're making a lot of money versus the purchase price. A lower cap rate, there's not a lot of income versus how much you're paying. We're seeing in the market now where people are buying a 4 or 5 cap rate, but the interest rates are 7, 8, 9%.
Yeah.
So the cash flow that's coming in doesn't even cover the mortgage payment. So how are you buying that? What are you doing? What's going on over there, right? So
that's speculative.
It's speculative. It's you're going in, you're taking a huge risk. There's no need for that. You just got to be able to shift, and that's why we saw that happening. We said let's shift a little bit. What is the next? And student housing is a niche under the multifamily umbrella, right? So we said, what's the hottest niche under multifamily right now, where it's a little more stable, and that's student housing. There's a huge demand for student housing. There is so much more demand that, again, Blackstone is building has another $1 billion fund, and they're buying student housing globally.
Sure.
What's his name? With the CEO or whatever his name, I don't remember his name. He came out and he says, "Thank God Blackstone has all this dry powder because we are going out now globally buying student housing all over the world."
It's a theme.
Because there's not enough. There's, people think, students are losing students, universities are losing students because you can online and home studies. Kids don't want to be at home. Kids want to be on campus, partying, living the student life, enjoying themselves away from their parents. They don't want to be anywhere near their parents. And what we're seeing is that these tier 1 universities, UGA, MTSU, University of Arkansas, they're exploding. Their freshman class is booming, right? They don't have any place to put the kids. You look at these universities that are 100 years old, they never expected to have 40,000 students, 20,000 students.
FAU, having the same problem. Yeah.
FAU,
Yep.
Right? What, 15, 20 years ago, it was 3,000 students, 4,000 students. Now they got 30,000 students.
Yep.
It's incredible. It's incredible. You don't see all these student housing projects being built anywhere, right? So there's a huge demand. And economics 101, man, supply and demand. Where there's huge demand and low supply, supply the demand.
Yep.
And that's what we're doing. Yep. We're buying these properties from the developers, right? The one in Athens, Georgia, we're buying it from the developer. It's a distressed sale. There was issues with the sales. They had to liquidate. We swooped in from our contacts with Biff, put it under contract, dude. And now we're buying a property where the competitors are pre-leasing for next year now. We underwrote at $400 increase, split over 2 years. So first year pre-lease $200, following year pre-lease at $200. They're now renewing a soft renew because we're under contract at $430. The competitor next door, which is the broker that brought us the deal, which is the owner of the property that we bought in last December, good old boy connection, right?
Yep.
They're leasing up at $700 above us. Wow. And they're our closest competitor. So
sounds like a no-brainer.
So again, we tell our residents, listen, you can leave, you can blah, 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 or just pay $600 increase over here, and we've blown our pro forma numbers out of the water.
Awesome.
I think the theme here, though, is because I see so many people misunderstand this. This takes a lot of work, time, effort to build what you've built to get that deal. This isn't, you got lucky.
No.
Right? Come on.
We built our luck.
Yeah.
We made our luck. We created our luck.
Exactly. So this is...
And you're not dabbling.
We're not dabbling.
You're not putting your big toe in this. Yeah. So.
No, we're not dabbling.
Yeah.
This is what you do.
Right. I don't do anything else. This is what I do,
Yep.
I've got my little home office. I've got my office over here, and that's it, First thing I wake up, just like you got, boom, 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 emails, text messages, phone, go to bed, check last minute. Okay. Yeah. Oh, I got to send this out. I got to send that out. I've got a conference call tomorrow. I've got this. I've got that. This is all we do. And going back to the LPs wanting to get involved, when you're looking at the GP team, you want to make sure that they're full-time people, that they're not, fly-by-night, real estate investors, right? They're 9-to-5ers, and then come 6 o'clock, they put on the real estate cap or cape, and they get behind a computer. And now I'm real estate. Well, what happened during the day when there was a fire or when there was, a gunshot or whatever it was, right?
Yeah.
Who was communicating with the property manager at that point? So we're full-time, 100%, and the people in my team, we were handpicked. When Charles and I met several years ago, he was working for a family office that I went to raise capital for a $27 million project in Winter Haven, Florida. It's beautiful on the lakes, and all this stuff, really nice. Anyway, to make a long story longer, the guy who owned the family office, he pulled me for a year because he wanted me to lose the deal so that he can sweep in and take it from me and buy it. I kept the project going. Charles was helping me, with all this. We finally turned around and we flipped it to another owner operator. We closed on it because that's the one thing that I tell buyers when we're putting a property under contract, or sellers, I should say. If I'm putting this property under contract, we're going to close on it one way or another. You're going to sell it. You're not going to end up not owning it, right? And then afterwards, after that deal was done, Charles and I built that relationship. He wanted to go back to school to get his master's degree. I wrote a reference letter for him. And then he went and did his thing and did his deals. And 2 years ago at a Rod Khalife event in Orlando, I'm walking in and he's walking out. First person I see, boom, we sit down on at the restaurant, and on the back of a napkin, we created MT Investment Group because it's Mosery Taylor. And then, so the point is that we handpicked the people to be on our team because we said, who do we need? We don't need the attorneys, the insurance guys, and the broker, because we all have that, right? That's not part of your business team, your company team. So we started, okay, let's bring in Brad, let's bring in Beth, let's bring in this one. And we handpicked people to create MTN because everybody on that team is a real estate professional. They're 24/7 in the deal. They're not doing something else. Brad, who came to us from the Navy, he's a government contractor, and he has his own company called Tiny Home Geniuses, where he built tiny communities of tiny homes.
Cool.
Right?
That's cool.
So everybody brings their different aspect and different connections and different views on things. So when we're working on a project, everybody's able to chime in, And I read Steven Schwarzman's book. I forget what it's called now. But anyway, in one of the books, in the book, he says, it doesn't matter if it's me or if it's an employee. When we're in our meetings, everybody say is equal. I want you to talk. I want you to throw out your ideas. I don't care if you're the person in the mailroom. If you've got an idea, come share it with us. And that's how we run our company as well. I don't care, if you're a 10% owner or if you're an executive employee, let's meet and give us your ideas, because I don't know what you think. I don't know your worldview. I don't know who you know or what your experiences are.
Smart. That's very smart.
Yeah.
So how, let's say someone's an LP, they want to learn more about your deals, and let's say they're an accredited investor, or they think they might be, maybe they're not 100% sure of what that entails. We'll put your contact information, of course, in the description of the video, but is there a specific way you want them to get in touch with you?
Yeah, they can feel free to email me, Nizan, Nizan, at mtninvestmentgroup.com.
Perfect.
My number is 561-212-7247.
We'll put that in the description of the video too.
Don't call me before 10 a.m.
Gotta have at least 2 coffees, right?
I don't take phone calls before 10 a.m. Again, this is our business. This is our life, right? So we set up and we train people how to act and behave to us, right?
Sure.
If you don't, then people will do whatever they want. They'll call you 7 o'clock in the morning. No, don't call me. I'm not. That's my time.
Sure.
And I will do with it what I want. We'll go for a walk, hang out with my wife, take my kids to school, be on the computer, whatever it is. It's my time. That's why I will never, very rarely Well, I set up a meeting before 10 a.m.
Understood.
I don't want to do that. That's not the life that I want to create for myself, right?
Perfect.
So
Yeah, that makes sense. Any other questions?
No, this was great. I mean,
Yeah, it was
you're
awesome.
the man.
Yeah.
We knew it was going to be awesome. Yeah.
Yeah, we were excited about this. You're our syndication go-to guru, so we appreciate it.
yeah, if anybody wants to talk about syndications, how to get started, if they want to get educated, I teach people. I have an online course as well. It's 10 videos with homework and sheets that I put together. Teaches you the language, the lingo, the jargon, the all the different equations and formulas that you need to know, how to talk to a broker, how to analyze a market, right? How do I know this is the right city to invest in? Right? There's criterias, right? How do I build a team? How do I network properly, right? Again, I was networking and I was doing it all wrong until I figured it out. And now I know exactly. So there's a lot of different components to the syndication world. And my partner, Laura, she says it best. She goes, to be successful, you have to run 12 marathons at the same time and cross the finish line on all 12 marathons at the same time. Right? And then, of course, I make the stupid joke, well, I can't even run from here to the end of the room by myself without getting winded. You want me to run a marathon, let alone 12 of them, right? Mm-hmm. So there's a lot of moving pieces to this. So you got to build your team. So and a lot of what these national gurus, the Rod Khalees, they're great. They've built an incredible group and
training structure.
Well, what they teach you is to invest and to be an investor, meaning, okay, I'm now a syndicator. I'm going to go out. I'm going to talk to the broker. I'm going to underwrite. I'm going to raise the money. I'm going to talk to the SEC attorneys. I'm going to read the documents. I'm going to do all this by myself. And I'm the Lone Ranger, and I'm going to go out and I'm going to do it. And a lot of people go out there, and the first 6 months, like, dude, I talk to the brokers. The brokers don't want to talk to me. They're sending me the crappiest deals. I'm looking on LoopNet. I'm looking on Crexy. What do I do? Where do I go? How do I get this? So they teach them the dry stuff, and they build a great network for you to connect with people. What I do differently is I teach people how to build a business that revolves around their lifestyle. Because even these people, when they're going to these boot camps, they come out, they're motivated, they're jacked, they're excited about their future. They come home, they put that notebook up on the shelf, they make a few phone calls to the broker. The brokers blow them out of the water because, dude, you don't even know what a cap rate is, and you're calling me and you want this, you don't know what going in, and they blow them out of the water. They try a little bit and they fail, or they go out there and next thing they know, they're going from one stressful job to another stressful job, right? What I teach is not only multifamily investing, networking, and all of that, and underwriting and whatnot, but I teach them how to build the business that will revolve around their lifestyle. What is it? And that's what we work on first. What lifestyle do you want to live? What's your vision for the next 12 to 24 months? Forget 5, 10 years, right? That's a great vision. That's a great goal. That is way too far out for people to think, right? Somebody comes to me today and says, what's your 10-year vision? Let me help you and mentor you. I'm like, dude, I'm 53 years old, man. I don't have a 10-year vision. I am on my 10-year vision right now, right? I'm in my 10th year of my 10-year vision back then. Talk to me about the next 2-3 years. Talk to me about, when I'm going to be 55, when I'm going to be 57, right? How's that going to look? So every single person has their own vision of what their lifestyle is going to be, what they want to do, right? And we got to focus on this, right? We got to focus on the negative limiting beliefs and convert them to positive expanding beliefs. And that's what I work on a lot with my clients, way before the multifamily even starts. Because what happens if you get lucky and your LOI gets accepted tomorrow? Then what? Did you build your team? Do you know what you're good at? Have you networked enough with people to go out and be successful with it? Do you have someone that can take you by the hand and take you step by step, right? So that's a little bit of the difference that I do with my clients than all these. Again, I grew up in that world with David Lindahl. I'm one of his students. He's the original guy on multifamily boot camps and whatnot. He's been doing it over 20 something years. But even him, he taught me, go to 2 networking events every week. Well, I did that. That wasn't successful. I had to figure out what worked and how really success looks like and how to build that business, right? Because I don't want people to I don't want you to get into another job. That's not the goal, right? The goal is to create freedom, to create passive income, freedom, and to create a business where it's humming. Now you can remove yourself from that business, and now you can go do what you want with it. Do you want to build another business? Do you want to be philanthropic and go out and whatever it is you want to do? But you can't do that if you're stuck. Even in multifamily, you can't do that if you're stuck behind a desk day to day running your business. You can't do that. See, like today, I've got a team. You know what? I tell them, listen, I'm going for a week. I'm going for 2 weeks, going for 3 weeks. Yeah, you can, blah, blah, blah. I'll be there. I'll connect. I'm not out, but I'm gone. You guys now take the management calls. You guys field it. You guys do this. You guys do that. It's all part of the business. It's all part of the team, right?
Mm-hmm. Yeah, supporting each other.
Mm-hmm.
Agreed.
Design your life around your business.
Design your life. Too many people live life by default. Well,
with the scraps that the business leaves them. Oh, okay.
Scraps. I grew up in a poor house. My parents were not entrepreneurs. They never taught me about business. I never did this. Dude, my dad never graduated the 6th grade. He was from Israel back then, right? When he was 16, he put on a uniform, took a gun, and he started fighting for the independence of Israel, right? He didn't know from school, right? My mother also, she's a Holocaust survivor. She never graduated school. She was in war-torn Europe, right? Fleeing for her life. She had to pretend that she wasn't Jewish to survive. I'm not going to say, well, my parents never taught me, or we didn't have the opportunities, or we didn't do that. No, man, right? So stop living by default. Stop saying, well, this is what it is. No, there's a way out. That's why we live in this country, right? Because in this country, and that's why people come to this country, because there's no limit. The limit is only in between your ears. What you set yourself up for, right? The success or the failure all happens in between your ears, and it happens in the morning when you wake up.
I love it. So true.
I love it.
So true.
I agree. I agree. It's all about your mentality. So
absolutely,
positivity.
Absolutely.
Well, good. Well, I think this was really awesome, amazing. Thank you, Nizan. You're a great guy. Again, we'll put your contact info in the subject of the video, and if folks out there have any questions regarding any of this, coaching, mentoring, being a limited partner,
absolutely, investing,
you're the guy. So,
man. Thank you.
Thank you. Appreciate it, Nizan.
Yeah. Thank you.
Thanks, man.
Okay.
Awesome. Thank you.